Hi everybody, and welcome back to video number 3 in chapter 2. This particular slide is not part of the PowerPoints for the Brewer text. It's from the Wild text, also McGraw-Hill, but I thought it nicely described the cost flows that we would have in a manufacturing environment, and I thought you'd get some benefit out of seeing this. So here we're going to purchase, here on number 1, we'll purchase our raw materials. We'll get to how we do that fairly easily. And then when we rack those materials into work in process, these direct materials come right into the work in process inventory into jobs. However, we have some indirect material, and that goes into our factory overhead as actual. Okay. We have other overhead that goes into the factory overhead as actual. That would include things like rent and depreciation and things like that. But we also have some indirect labor that goes into our factory overhead. Okay. And then some direct labor that goes directly to the jobs, just like direct materials do. Now, when we apply overhead, right, it comes out of the factory overhead account and into the work in process account. So at this point in time, this work in process for job Bravo 17 includes $300 of material, $1,200 of labor, $1,920 of overhead that we've applied. Okay, now that's the only job that was left in work in process inventory because we've applied 2 other jobs here to finished goods inventory. Their job Bravo 16 here for $6,000 and Bravo 15 for $3,300. Now, Bravo 16 stays in finished goods inventory here, while Bravo 15 moves into cost of goods sold because we've sold it. Okay, now you will notice here that factory overhead has a $200 debit balance, right? So that means it was under applied. We didn't apply enough overhead here to offset all the actuals here. So we debit factory overhead for actuals, we credit factory overhead for what we apply. And so that left us a $200 unapplied overhead. And the way we're going to get rid of that, I will just tell you in advance, not to jump too far ahead. We'll debit cost of goods sold and credit factory overhead so that we zero out that factory overhead at the end of the month. Then here are our journal entries for all of that. Here's where we acquired raw materials, we debit raw materials, credit accounts payable. Here's where we move that direct materials into work in process inventory. That's direct materials. And here's where we move direct labor into work in process inventory, right? And the credit is to raw materials inventory here for direct materials and to factory wages payable for direct labor. But we also have some indirect materials that we use. And as you can see, that is moved into factory overhead. The credit again is to raw materials inventory. And then finally, indirect labor will again debit factory overhead for $1,100, and the credit, like it was for direct labor, will be to factory wages paid. Now we apply the overhead. In this case, the predetermined overhead rate was 160%. of direct labor. So that was 6720, and we move it into work in process inventory and out of factory overhead account as a credit. You'll remember, here's the credit here. Now, for factory overhead, we had several items other than indirect labor and indirect material. We had accumulated depreciation on factory equipment, rent payable, utilities payable, prepaid insurance. Those are all actuals. And that goes as a debit to factory overhead here. Okay, finally, we move 2 jobs out of work in process inventory with a credit and into finished goods inventory with the debit. For cost of goods sold, we debit cost of goods sold for what we sell and credit finished goods inventory to reduce that inventory because it's going out the door to our customer. But at the same time, we record the sale by debiting accounts receivable and crediting sales. I think that's a pretty good summary of the cost flow journal entries. And of course, in this particular example, we also had to do the debit to cost of goods sold and a credit to factory overhead to zero out that factory overhead. Of course, that does not go to the jobs. So our jobs are under costed a little bit by $200. Now, as we transition back to our PowerPoint for the Brewer text, we also know that we use job order costing not just for manufacturing, but for service companies too. So if you're a law firm, for example, or for that matter, an accounting firm, you have different clients and different costs associated with each of those. And you can use job order costing for those services as well, for law firms and accounting firms and medical firms, or medical clinics, or whatever you want to call them. And we would use the same approach there as we use for manufacturing. Of course, it's slightly different depending on what kind of a company you have. But that job order costing is used in many different types of service companies. Okay, that ends chapter 2. And when we come back, we'll start looking at chapter 3, which will start getting into the meat and potatoes of the managerial accounting in a little more depth. Until that time, bye for now.